The Reserve Bank of Australia released its June meeting minutes this week, describing its decision to cut rates this month as finely balanced. Joining me now to share their expert opinions on the RBA and the Australian economy are Sydney-based Senior Currency Strategist Emma Lawson from National Australia Bank and Sean Callow from Westpac. Thank you both for joining me. Now, this is a question directed at both of you. When looking at other areas of the world right now, the Australian economy is actually in a pretty good shape. We've got better than expected GDP figures, low unemployment and moderate inflation. Yet the market is still calling for further rate cuts. Is this just due to the current environment of volatility and global uncertainty right now? Emma, let's start with you first.
Yeah, it is. They see that what they've already done so far is probably adequate for the domestic economy, but the global uncertainty it drove their last move, and it's driving that wedge between where people think that the RBA would go on domestic conditions, but adding on a premium for that international uncertainty, and that's likely to continue for some time.
Yes, look, it's really very heavily focused on what's happening in Europe and to a lesser extent the US and to some degree Asia as well. So we've got cooler growth numbers in Asia without being anything too alarming. But there's no doubt the Australian dollar does react quite closely to global events if they're regarded as sufficiently worrying. And that's certainly the case at the moment. The market does think that the news will get worse around the world in coming months and that will eventually impact on Australia, even though, as you say, for the time being, the macro domestic numbers really are pretty good.
Sean, how much do you think markets then are pricing in a cash rate of in the next 6 to 12 months?
We're looking for a further 75 basis points off the cash rate to 2.75, expected to mostly occur in the next few months. So we did receive the RBA minutes today, which indicated that they weren't in potentially a great hurry, but we do think that the risks are firmly to the downside, that inflation will be low enough for lower rates, and the market has, for the most part, been more aggressive.
And Emma, what about your forecast at NAB?
You can see kind of almost up to maybe 100 basis points, and we only expect another 25 basis points, possibly another 25 after that, depending on the data. So again, the market has more priced in than we currently expect, but this has been the trend and has continued for at least the last year. So we're not expecting that differential is removed in the short term.
Looking at the shorter and longer term horizon, Emma, how do you see the Aussie dollar trading versus most of its major trading counterparts, and why?
The Aussie dollar is holding relatively well, considering the 125 basis points cuts that we've already seen by the RBA and the drop in commodity prices that we've seen over the last 6 months. What we expect going forward is that premium to slowly be eroded and it start to depreciate, but very, very gradually into next year.
Sean, do you see a similar outlook for the Aussie dollar?
Well, I think that we almost certainly have seen the high for the cycle for the Aussie dollar against both the US dollar and the trade-weighted basket. So the highs we saw above $1.10 about 11 or 12 months ago are likely to be the highs of the cycle. But look, for the next few months, certainly against the US dollar, while we do see some downside risk in coming months, particularly if we get further bad news out of Europe, I suspect that we will end the year more higher, so maybe 103, 104 area and a little bit higher into next year.
What about the overall outlook for the Australian economy, looking at consumer demand, growth, inflation and Australia's patchy economic activity in certain sectors?
Yes, it really is patchy. We've got the mining sector growing at something like 9% year over year, whereas ex-mining is more like 2%. So, of course, the benefits of the mining boom are spread to some degree to the rest of the economy, if only through tax revenues, etc. So I think that helps limit the downside for the Australian economy. The consumer overall in Australia is a lot more cautious than they used to be. The savings rate has risen substantially since the global crisis, and it really does look as though it's going to stay a lot higher than it was in, say, 2006, 2007. So I think the consumer will remain more cautious.
Emma, the same question to you. What's your outlook for the Australian economy then in the coming quarters?
with policy rates coming down another 25 and possibly 50 basis points, that will allow the RBA's expectations that they meet their inflation targets of around 2.5% over the next couple of years. And it also allows very moderate growth of around 3% in the next year as well.
Sean, I'll end on this point with you. How are worries over certain European government bonds changing market sentiment? And what's your review on Australian government bonds right now?
Yes, well, we are certainly watching what's happening in the European bond markets pretty closely every day. We keep an eye on them to see is there something that we should be worried about here, signs of an increased risk aversion in particular. The Australian bond market has been extremely resilient. It's finding very broad support from Asian investors, so there is a lot of demand for there. There's no sign of particular concern. Yields keep pressing lower, and the government insists that the budget will be back in a very small surplus by the financial year, so that will help underpin the Australian government bond market.
Sean, Emma, thank you very much for both joining me. I'm afraid that's all we actually have time for at the moment, but coming up on Dukascopy TV, we'll be discussing the latest German ZEW figures and a fresh edition of Targets in Focus. For the moment though, goodbye.